behind brands like Stripe, Dunkin' Donuts, Fortnite, Hilton Hotels, or even Burger King stand giants you may have never heard of. Blackstone, KKR, Apollo, Carlyle, TPG, Ardian, or CBC. If these names don't ring a bell, that's intentional. They operate in the shadows. Yet year after year, they outperform the markets by a wide margin. KKR has delivered an astonishing 25.8% annualized return since the 1970s. Apollo has been compounding at nearly 24% since 1990. Their ruthless methods have earned them a reputation as the true overlords of capitalism. Today, I'll show you two things. First, how these funds operate, and second, how you can apply their methods yourself if you ever want to take the leap. Specifically, how to buy a company even if you don't have the money, through a discreet but incredibly powerful technique, the LBO. In one sentence, private equity means investing in companies that are not listed on the stock market. Public companies are the ones traded on exchanges, available to anyone with a brokerage account. You can buy their shares in just a few clicks. Private companies, on the other hand, are not listed, which makes accessing their capital much more complicated. And in this universe, you'll find both ends of the spectrum. From the small family-owned restaurant down your street, all the way to massive global brands that have deliberately chosen to remain private like Chanel or IKEA. Here's a number that may surprise you. 99.9% of companies worldwide are private. To become a shareholder in one of them, you need different tools than the ones you use on public markets. The equity of a company simply means you own a portion of it, so if you hold 15% of a company's equity, you are effectively a 15% owner. And with ownership come powerful rights. You get a say in major strategic decisions like appointing leadership or relocating headquarters, proportional to your stake. The more equity you own, the more influence you have. Like public stocks, you can earn dividends and capture capital gains when you sell. But here's the question. Why even bother with private equity? Because the top funds have consistently outperformed indexes with annualized returns of 15, 20, sometimes even 25%. At the core of their playbook is one strategy, the LBO. Buy private companies, scale them, and sell them for massive gains. Sounds simple enough, but in practice, it's one of the most complex games in finance. So let's break down how it really works. Private equity isn't a single strategy, it's an entire ecosystem of approaches, each one targeting companies at different stages of their life cycle. The first, and probably the most famous, is venture capital. This is where investors put money into small, young, fast-growing companies that haven't yet proven themselves on a large scale. They're aiming to spot the next NVIDIA or Google. Another strategy is distressed investing. This is where funds swoop in to buy companies on the brink of collapse, firms drowning in debt, mismanaged, or hit by crisis at rock-bottom prices. The play is simple in theory. Buy them cheap, fix them, and sell them later. It's risky, but when executed well, the returns can be absolutely massive. Apollo, for instance, became famous for buying struggling companies like Hertz during downturns, restructuring them, and selling them later at huge profits. Then comes the crown jewel of private equity, the leveraged buyout, or LBO. This is when a fund acquires a mature company by using a massive amount of debt. We'll dive deeper into this technique in a moment, because it's the single most powerful weapon in private equity's arsenal. Put simply, an LBO means buying a company with debt, fixing it up and selling it for enough to wipe out the loan and still walk away with huge gains. There's also infrastructure. This is where private equity meets the very foundations of our economy: airports, highways, or telecom networks. Long-term, stable cash flows. Not spectacular, but highly predictable, and often backed by government contracts. And finally, private debt. You're lending directly to companies, but at yields usually much higher than government or corporate bonds. And as a creditor, you're far better protected than a regular shareholder. We'll dive deeper into private credit in a future video if you're interested, since this is one of the fastest growing segments of the industry today. Let us know in the comments. So how does a private equity fund really operate? Let's break it down step by step. At the top, you have the general partners, often called GPs. They're the brains of the operation, the ones who source opportunities, negotiate deals, and run the investments. Think of them as the managers of the fund. Then you have the limited partners, or LPs. They're the ones providing the capital, usually hundreds of millions, often billions of dollars. These LPs can be large institutions like insurance companies, pension funds, and retirement systems. They also include sovereign wealth funds, ultra-wealthy families, and family offices. But here's the key point. When you invest in a private equity fund, the money isn't deployed right away. Instead, it's called gradually each time the fund finds a new opportunity. That process can take months, sometimes even longer than 6 months. Once the capital is drawn down, the fund typically uses it to execute LBOs, leveraged buyouts. And the life cycle of a deal usually follows 3 big steps. First, acquiring a company. Then, over about 5 years, restructuring, cutting unnecessary costs, and optimizing it to boost performance. Finally, selling the company, with the goal of realizing a significant profit. That's when the private equity fund gets paid. They return the money to their LPs, ideally with a hefty gain, while also collecting their own share of the upside. Blackstone has grown from just a small boutique in the 1980s into the world's largest alternative asset manager, overseeing more than $1 trillion in assets today. The power of this structure is that it creates an almost unstoppable incentive. The bigger the fund, the more deals closed, the more wealth accumulated. It's a machine that feeds on itself, and it has transformed the financial landscape over the last 4 decades. Now, let's zoom in on the technique that truly makes private equity so powerful, the LBO or leveraged buyout. At its core, an LBO is simply about buying a company with mostly borrowed money. But for it to work, 2 conditions are crucial. First, the company needs to generate steady cash flows to service the debt once it's acquired. And second, the market it operates in must be relatively stable, mature, and not require massive reinvestments. Here's how it works. Think of it like real estate. When you buy a house, you don't pay the full price up front. You put down some equity and borrow the rest. It's the same with an LBO. The fund puts in roughly 30% of the price, using the money provided by its limited partners. The remaining 70% comes from debt. The company is then acquired, and it doesn't stand alone. It becomes a subsidiary of a holding company created by the private equity fund. This structure protects both the fund and the target company from legal and financial risk. But private equity doesn't just throw money into the deal and walk away. Once in control, the fund brings its full expertise, its network, its strategic guidance, new management talent, financial discipline, and most importantly, the playbook refined from dozens of past buyouts. In other words, they don't just own the company, they transform it. As revenues grow and costs are reduced, the business generates stronger cash flows. And those cash flows aren't just profits. They're used to gradually pay down the debt, that very 70% borrowed to buy the company in the first place. That's the true power of the LBO. Using leverage not only to acquire control, but to multiply returns once the company is improved and eventually sold. After a few years, the company will eventually be sold, sometimes to another private equity fund, sometimes to a competitor, and sometimes through an IPO. The goal, of course, is to generate the largest possible profit on that exit. That profit is then used to pay off any remaining debt. But most importantly, it's what allows the fund and its LPs to get paid. The profit on the sale maximizes the margin, but the real engine of returns is the leverage created by debt. Remember, 70% of the purchase was financed with borrowed money, and by the time of the exit, that debt has been repaid using the company's own profits, which means the fund captures the full upside without having put in that extra capital itself. On top of that, this part isn't treated as a taxable capital gain. Only the amounts exceeding the initial equity investment are subject to taxation. And there you have it. Now you know exactly how a leveraged buyout works.